Okay, here is an explanation of closing journal entries and why we do closing entries. We close only temporary accounts, not any of our permanent accounts. So our temporary accounts include revenue, expenses, withdrawals, and income summary accounts. Those are the ones we close. And the reason is, remember, our income statements, the heading on our income statements are for the month ended October 31st, or for the quarter ended October 31st, or for the year ended October 31st. So if we're only looking at income statements for a certain period of time, we need to somehow get our income statement balances back to zero when we start the new year. In January, we don't want our beginning balance in revenue to have a number in it. You want it to start at zero. You want your expenses to start at zero. So we have to close these accounts at the end of the year or quarter or month, whatever period we're doing. So we would start with a revenue account like graphic design fees that has a credit balance of $8,000. Office salaries expense that has a debit balance of $1,650. Advertising expense that has a debit balance of $250, and telephone expense that has a debit balance of $300. So then we have to make revenue and expense accounts go to zero is our first step. So how do we do that? Well, if this has a credit balance, we need to debit it, right? And our offset is going to go to income summary. If these have debit balances and expense, we need to credit those amounts, those accounts, okay? So our journal entry would be debit graphic design fees, $8,000, credit income summary. We would debit income summary $2,200, which is the sum of our expenses, and then credit office salary expense, advertising expense, and telephone expense. So when we post those up into these T accounts, we can see our revenue and our expense accounts are all at zero now. Okay, step number 2, close income summary to capital account. So we had $8,000 go to income summary, a credit, and $2,200, a debit, go to income summary. So that results in a balance, a credit balance of $5,800. Well, now we got to close out income summary because this is just a temporary account. So we debit income summary to get it down to zero, and we have to have a credit, and that goes to capital. So here's our entry, debit income summary, $5,800, credit capital. Then we also have withdrawals account here that also closes, and you want to reset at zero. So we credit withdrawals, and we debit capital account to get that to zero. So then our ending capital balance is $15,150. Our revenue accounts at zero, our expenses are at zero, our income summary is at zero, and our withdrawals are at zero. So the idea is everything, revenue, expense, withdrawals, income summary resets to zero for new year, and balances go to capital. Okay, so that concludes this explanation.